Hey guys, this is Nick from Financially Aware, and in this video I want to talk about the craziness that's going on with Hertz Stock. Now, I did a video on May 27th saying that Hertz Stock is going to zero, and this was one day after they announced the bankruptcy, and Hertz was trading at around $1, and now just 10 trading days later Hertz was up over $6, so like a 600% gain since I said Hertz is going to zero. And it is up over 1,000% from the lows that it made after the bankruptcy announcement. So what the hell is going on with Hertz? How did this happen? What are some of the reasons? And what should you do now if you bought it, if you're thinking of buying it, if you're thinking of shorting it or buying put options on it? I'm going to talk about what's going on with it, why it happened, and why you should really stay away from it. Now, first of all, have I changed my mind or my analysis that Hertz is going to zero? No, it's still going to zero. That's what happens in bankruptcy. The bondholders, make a deal where they give up some of the debt that they're owed, and they take the company in stock. And so they rip up the stock of the old shareholders, and now they become the owners of the new company as it keeps operating. But a lot of people don't realize this is how this works, and so this is not the first time this has happened. It's not the last. This has been going on for years and years and years, and I'll give you some examples. I remember this in 1999. Around that time, Boston Market was going through bankruptcy, and the same thing happened where people would bid up the stock even though after they announced the bankruptcy filing, in the hopes, based on some anecdotal evidence like, oh, Boston Market has 500 locations, just the real estate and the buildings, got to be worth more than, the stock price or something like that. And so they would bid this thing up and have these short squeezes because the professionals knew it was going to zero, but even if they shorted and a bunch of people bought it, it would still go up and they had to cover their short. And so there were spikes in the stock. However, the inevitable happened, and McDonald's came in and bought all the debt and took on all the debt for a fraction of the total debt outstanding, ripped up all the stockholders, they got nothing, and that was the end of it, okay? Same thing happened in 2009 with GM. A lot of people, the same anecdotal evidence where they go, oh, GM is too big to fail, the government's going to bail them out, so therefore I buy the stock because it's going to keep operating and recover. Yes, it is going to keep operating and recover and get bailed out, just not with the stock that you bought. The debt holders will rip up that stock and take the new stock for themselves. And that was even, the plan was put out into the news, okay? And they said, hey, here's the plan. And in the plan, we're going to rip up the old stockholders. They're going to get 1% of the current value now. And so the stock was trading at $1.85 at the time of this news story, saying that you're going to get 1 penny for your $1.85 stock. And yet people were still buying GM up until the day that they canceled the stock and they all got zero. So this is nothing new. The only thing that's new, and like Mark Twain said that history doesn't repeat itself, but it rhymes. So the same thing happens over and over because there's a new class of investors every time, and they don't know, how bankruptcy works, and so they bid up the stock and they get, they see the price go up and they all get excited and buy it more. But I'll tell you one thing. The people who were buying Boston Market stock when it was bankrupt in 1999, they got burnt. They learned their lesson, most of them. And so they weren't the same people that were buying GM stock in 2009. And those people that were buying GM stock in 2009 that all got burnt, I'm pretty sure they're not the ones that are now buying Hertz stock today. This is a new class of investors that are buying this that didn't get burnt these other times, most likely. And so unfortunately they are going to get burnt if they're buying this with the anticipation that somehow it's going to come back, or they read a story that, oh, airlines are doing a little bit better, than 3 times more than they thought they were gonna, but they're still down 86% and something like that. All that stuff is irrelevant because the bankruptcy plan is still gonna be to wipe out the debt of the debt holders and give them equity in the new company and ripping up all the shareholders of the current Hertz holders. So no matter how good the economy rebounds, it's not going to help Hertz. And people like Carl Icahn realized that, and that's why they sold all their stock, even though they sold it at 70 cents, because they know it's still going to be a zero. So if the stock's going to zero, what should you do if you own the stock? Should you sell it? That's your call. Should you buy some now at $6 or wherever it is? I wouldn't. Like I said, it's going to zero. It's not going to zero tomorrow. It's not going to zero in a month. It has to wait for the plan to get approved and, all of that to happen. That could be months. That could be a year or something like that. So, people are trading in and out right now. And if they're making money, God bless them. Good for them. I'm just trying to save people from losing money on this thing. And so some people may be thinking, okay, well, if it's still going to zero, definitely, and I don't want to buy it, hey, why don't I short it? Because if it's going to zero, that's an easy 100% guaranteed gain, right? Yes and no. There's a big problem with that. 2 problems, actually. One is when you short something, you have unlimited risk. So you see the stock was at like 70 cents or something like that, and it went up to $1.50, let's say. You just lost 100% of your money. And if it went up to $2, you lost 200% of your money. So it's unlimited risk on the upside and only 100% gain on the downside. So that's the problem with shorting. The other problem is that one, there was a lot of short sellers in this thing, and the reason why this thing ripped is probably because a lot of them are covering their shorts because all these small traders are buying it because of the cheap stock price, and they don't realize that it's going to zero. So it made the price go up, and the short sellers had to buy it back as quick as they can, and that's what spiked it. However, the stock is hard to borrow, and I don't know if you know how short selling works, but if you want to short sell the stock, you have to borrow the stock from somebody else that owns it, and your brokerage will find that stock for you, usually with another customer of theirs that owns the stock. They'll borrow it from them and loan it to you. Now, the loaning is not free. They charge you a yearly percentage rate. And currently today, I looked up Hertz borrowing rate to short the stock, and it's 94% per year. So what that means is if you short this stock today, say at $6, and it stays at $6 the whole year, and a year from now they go, okay, bankruptcy plan's out, we rip up all the stock is zero, and you go, okay, great, I made 100% on my money. But Interactive Brokers charge you 94% of that stock price over the year. So you only made 6% on your money. So like I said, it's hard to borrow. It's very expensive to borrow. Interactive Brokers is one of the cheaper ones to borrow. So some other brokers, it may be over 100% to borrow. Okay, so stay away from that. And then other people will think, okay, well, don't buy it, don't short it. What about buying puts on it? Again, same kind of thing. They are way overpriced. Just the July puts at right about at a 550 strike price, right about break even. I looked at them after market, but they were had about $3-4 in premium, time value just for that 39 days. So let's say you shorted it at 550 and it went to zero in a month. You're not making 550, you're making maybe 250 or something like that. And like I said, it's not going to happen overnight or in a month. And the implied volatility on the puts are over 500%. Now, to give you a comparison, if you don't really realize how volatile that is, the SPY puts for the same amount of time out into July, at the money is like 21%. So it's like 25 times more volatile than the S&P 500 ETF. So I don't want to be a party pooper, because I know people want to make money, and so they want to hear, hey, buy this and this cheap stock and it's going up 100%, and look, it went up 300%, you missed out, FOMO, you could have made this, and people are bragging about the money they made and stuff like that. That's fine and all, but that doesn't last forever, and you really got to know what the hell you're buying. And if you got burnt on Hertz, or you're going to get burnt if you're holding it too long, learn a lesson from Hertz. And for the next so-called Hertz is going to be Chesapeake Energy, and they are up 300% from Friday, even though they had a 30-for-1 reverse split just a few weeks back. And just tonight, they already have news that they are going to be filing for bankruptcy, and it's basically a whole wipeout. They're even worse off than Hertz, and they're already talking about giving all their assets to their lenders, just giving it all up, because there's no value left after all the debt is paid. So this stuff is going on all the time. So there's no free lunch, and these cheap stocks are cheap for a reason. There could be a short squeeze. Everybody from Robinhood could pile in, and it could go up for a few days, but the end result is going to be that they're going to be zeros. And so don't put any significant amount of money in this, and definitely don't try to short it or buy put options. If I was you, I would just stay clear of Hertz and Chesapeake. So if you like this video, give me a thumbs up, leave me a comment, and subscribe to my channel if you haven't done so already. Thanks for watching.